Hello, future billionaires. Welcome back to another episode. Today, we brought on a cost segregation expert, Erik Oliver, talking about cost segregation and how it impacts passive investors. And so, if you are not familiar with this term, you definitely want to tune in because this is a very, very powerful tool to have in your arsenal when you're investing in real estate. And even if you are familiar with cost segregation, you've been investing for many years in real estate, you should still tune in because we talk about some of the changes coming down the pike, specifically how these rules in the tax code can be benefiting passive investors specifically, not just active investors. And we also talk about the lazy man's 1031 and some ways that you can use these passive tax losses and carry those forward for future passive gains, and how to really kind of manipulate your income to where you want to be and pay less taxes, which we all want to do. And so I had a lot of fun talking about taxes in this episode, which is not something I say very often. I think you will enjoy it as well. So we appreciate you listening. Again, if you like this podcast, we really appreciate the support. If you're willing to leave us a review on iTunes or any other platform, we really appreciate that. So we continue to share the knowledge and with the guests that we bring on, and really appreciate you all. Hope you enjoy this episode. This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Looking for passive investments done for you? With Aspen Funds, we help accredited investors that are looking for higher yields and diversification from the stock market. As a passive investor, we do all the work for you, making sure your money is working hard for you in alternative investments. In fact, our team invests alongside you in every deal, so our interests are aligned. We focus on macro-driven alternative investments so your portfolio is best positioned for this economic environment. Get started and download your free economic report today. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Fraser, joined by fellow co-host Jim Maffuccio today. And we are talking with Erik Oliver, who is the Cost Segregation Authority. And, very excited to have Erik on, especially at this time of year. So this is, being released right at the beginning of 2023. And there's been some changes going on kind of in the tax realm as it relates to real estate investing. And so we wanted to bring Erik on to kind of discuss what some of those changes are. And this is a primer for cost segregation. So Erik, thanks so much for coming on the podcast.
Yeah, thanks, Ben, for having me. I'm excited to be here.
Yeah, well, for those that are confused by cost segregation, maybe they've heard of it, maybe they haven't heard of it, give us kind of a primer on what it is and why is it important, and why do you want to be an authority in cost segregation? It sounds kind of boring, honestly.
No, that's a great question. My kids ask me that same question all the time. They're like, "Dad, what is it you do for a living?" And how do you do that? So that's a great question, Ben. So cost segregation really is just accelerated depreciation. And so one of the benefits of owning real estate is that you get to take depreciation, which is a form of an expense. It's a non-cash expense. Just like any other expense, you get to take that expense against your income. And typically depreciation is either you depreciate your buildings either over 39 years if they're commercial buildings, or residential buildings get depreciated over 27 and a half years. And so just to make the math easy, if you were to buy a $275,000 single family home, you're going to get about a $10,000 write-off every year over the next 27 and a half years. So that $10,000 write-off, let's say you make $100,000 a year, instead of getting taxed on $100,000, now you're only taxed on $90,000 because you have this $10,000 depreciation expense, correct? So that's kind of standard depreciation. We call that straight line depreciation. But what if you could accelerate those deductions? So I may not own my home or my single family rental for 27 and a half years. And so I want to accelerate those deductions. And the way to do that is through a cost segregation study. And really what that is, Ben, is accelerating those deductions by segregating the different items that you purchase when you purchase, in that example, a single family home. So when you purchase a single family home as an investment property, you're not just purchasing the land and the walls, you're also buying some appliances. You're buying a ceiling fan, you're buying a garbage disposal, a washer and dryer. There's all these different components. You're buying a driveway, you're buying landscaping. And the IRS says that all these components should be depreciated at a faster rate than 27 and a half. Because if you think about it, carpet doesn't last 27 and a half years, right? Your driveway typically doesn't last 27 and a half years. And so by having a cost seg study done, we come in and we take that, again, in that example, a $275,000 purchase, and we segregate the costs into different buckets. We say, okay, out of that 275,000, 20,000 of that was for flooring. 10,000 of that was for the driveway. 15,000 of that was for the landscaping. And by putting it in those different buckets, it allows us to depreciate that carpet over 5 years versus 27 and a half. It allows us to depreciate the driveway over 15 years versus 27 and a half. So you're just front loading your deductions.
So there's a connection, there's a nexus between the particular item that's being segregated and its typical useful life, right? I mean, that's the kind of general principle behind it. So you can accelerate it because it's not going to last 27 and a half years.
That's correct. Yeah, the IRS is basically, there's a big book that the IRS has taken just about any item you can think of.
Of course there is.
Tells you. Yeah, they really make it nice and simple. They take any item that you can think of and they say, okay, carpet gets depreciated over 5 years. Now, the problem is that when you buy a $275,000 single family home, you don't know the value of the carpet. You just look at it as one big lump sum of asset, and you typically depreciate it over 27 and a half years. But a cost seg company will come in and segregate that and say, okay, you did buy some carpet when you bought that home, and that carpet is valued at whatever, $8,000, $10,000. And now you get to take that carpet and put it as a line item and depreciate that carpet over 5 years instead of 27 and a half.
And are those time frames per item, are they set forth in the code somewhere, or is that where you have some subjectivity or what?
There is some subjectivity. However, the IRS does publish an audit guide on cost segregation.
Okay.
Kind of the way this came about, Jim, was at some point, someone took the IRS to court and said, listen, I'm not depreciating my flooring over 27 and a half years because flooring doesn't last 27 and a half years. So there was a court case where they said, you know what, you're right. Flooring only lasts 5 years. So we're going to change that to 5-year assets. And so there's all these court cases and case law. There is some subjectivity to it, but there is an IRS audit guide that basically says in a building, the flooring should be depreciated like this. The countertop should be depreciated like this. And so there's an audit guide that we follow where they've pretty much outlined how all this stuff should be.
And those are, at the very least, those are safe harbors. Like if you use those time frames, you're not going to get questioned. But if you could make a case that maybe the life of a component was less, that's where the subjectivity comes in. You could push.
Not so much on the individual asset. I think the subjectivity comes in. Is this carpet worth $9,000 or $12,000?
The additional value. Got it.
Yeah. And so that's where the expertise of having somebody with a background in construction comes in to identify. And then not to get too complicated, Jim, but there also are like indirect costs that get factored in. Like when you build a building, you have to pull a permit. You have to get architectural fees. You've got construction loan interest. There's all these other outside indirect costs or soft costs that we also tie in, and we put a value to those, and those get divvied up amongst the different assets. So, it's more than just pulling the assets out. There's a kind of a process to it, but the IRS has published an audit guide that tells us how to do these. And so as long as you follow that audit guide, you're pretty good. And again, there's a number of reasons why we want to do this, right? I mean, deduction today is worth way more than a deduction 26 years from now. Or again, I may not even own my building 26 years from now. So give me my deductions today. Let me go reinvest that money in a new duplex. Let me go pay down some debt. Let me go buy a boat, whatever it is you want to do. Give me my money today versus letting the IRS hold on to it.
And from an investor standpoint, I mean, this is very powerful, right? Because if you can defer taxes and you can redeploy those savings into other, cash flowing or, assets you can grow, then over time, that's going to be very meaningful. And it's kind of funny as you're talking about suing the IRS for basically, paying taxes, where any other business, it doesn't work. But in real estate, they basically created your whole industry through a lawsuit that they apparently won, and now,
way to go.
Yeah. So
Yeah, there was one big court case. It was Hospital Corporation of America. Hospital Corporation is a big outfit out of Tennessee. I believe they're headquartered in Tennessee. They have a bunch of hospitals throughout the Mid-Atlantic area. And back in, I believe it was the early to mid-90s, they had some pretty savvy CPAs that said, hey, why are we depreciating this laminate flooring over 39 years? There was a court case at one point that said it should be a 5-year asset. So they started doing, it's kind of when modern cost segregation was born, but they basically segregated all this stuff, created this massive deduction. And the IRS, they filed their taxes, saved millions of dollars in taxes. The IRS said, hold up, wait, what's going on here? What are you guys doing? And they're like, listen, we're just doing what you guys have in your code. We're just interpreting.
Right.
What the IRS put forth was they basically said, if I were to replace my carpet, I get to depreciate that new carpet over 5 years. They never looked at it like when I buy a new building or an existing building and there's carpet in there, that carpet should be treated the same way as if I were to replace carpet in a building, right? It's just no one knew how to pull those numbers out. And so that's where cost segregation kind of was born.
Got it. So I know there's somebody in the audience that's thinking, okay, you're talking about a tax savings, but aren't you just kicking the can down the road? And I think the answer in general is you're reducing the basis in the property, right? But then when you have an exit event, that moves over to the capital gain side of the equation. And then if you're using like a tax deferred 1031 exchange, you're continuing to kick that potential capital gain down the road. So it really is creating, it's creating money out of thin air in a sense. If you exit properly, right?
Yeah, no, there's some strategy to the exit, but even like 1031s are a great tool because it does defer those two types of tax. When you sell an asset, you pay your recapture tax. That recapture tax is typically calculated based on the amount of depreciation you've taken. I think that's what you're getting at is I'm sitting here saying, hey, front load all that depreciation, but when I sell it, don't I just have to pay it back? And the answer is no. And yes, you do pay it back. If you don't do a 1031 exchange and you just pay it back as a capital gain, you're paying it back at the highest rate of 20%, but you're taking your deduction at like a 35 to 40%.
You're moving it into a different bucket altogether. Yeah.
Right. You're moving it into a different bucket, and we're playing a rate arbitrage where you're taking your deduction at 35, 40%, paying it back at 20% and saving the spread. That's the first
thing.
So
even if you don't continue to defer, you win. I mean, you're already winning
right there.
Yeah.
Yep. You just saved 15% on your taxes by taking a deduction at 40%, paying it back at 20%. Well, in that case, 20%, saving 20% in a rate arbitrage. That's the first thing. The second thing is you don't actually have to pay it all back. You pay a portion of it back. And so I'm going to kind of back into this example because I think it's easier. But let's say you buy a building for $1 million and you sell it 5 years later for $2 million. If you don't do a cost segregation study, you're telling the IRS that everything doubled in value. I bought everything for $1 million. Everything is now worth $2 million, and you're paying tax on that $1 million of gain. But what are your 5-year assets worth after owning your building for 5 years? What's your carpet worth? It's worth zero book value anyways.
Right.
But when you don't do cost seg, you're saying, hey, my dirty old nasty carpet that I bought for $1 million is now worth $2 million, and I'm going to pay tax on that. Well, carpet doesn't go up in value. Your land and your walls go up in value, but your what we call personal property, your carpet, your countertops, your cabinets, your appliances, that stuff doesn't go up in value. That stuff goes down in value. And so your 5-year assets are worth zero on the books after 5 years, which means you pay no recapture tax on them after 5 years.
Wow.
If you don't do cost seg, again, you're telling the IRS that dirty, nasty old carpet you've had for 5 years is worth double what you bought it for 5 years later. And here I'm going to pay tax on that.
And does that apply to all the accelerated personal items in there? So if it's a 7-year or a 10-year depreciation schedule and you sell it in 5 years, whatever is remaining in value is taxed?
Correct. Yep. So like typically on a cost segregation study, we take a 27.5 or 39-year asset and we move it into either a 5, 7, or 15-year bucket. So if you own your building for 5 years, that stuff gets no recapture. If you own it for 7 years, your 7-year stuff falls off. If you own it for 15, your 15-year stuff falls off. So the longer you own it, the bigger your tax savings is essentially. But again, even if you buy it this year and sell it next year, you're still going to save that 20% on the rate arbitrage.
The difference between the rate. Yeah.
Yeah. Taking your deduction, even if you pay it all back, as long as you're paying it back at a lower rate, you come out ahead.
But then just to be clear, but if you do decide to defer it through a 1031, you're not taking that recapture and being taxed on it even at the lower rate. It's just your new basis that moves forward into the next adventure,
Yep.
right?
Yep, you got it. So yeah, we have a lot of investors who buy a property, do a cost seg, 1031 exchange into a larger property, take that additional new basis, cost seg, you 1031, 1031, 1031, and then unfortunately all of us die at some point. Leave that to our estate. It gets a step up in basis and nobody ends up paying tax on it. And
I like it.
Now,
that's
sorry,
never the
let's
strategy.
pause there because so let's walk through that example again.
Yeah.
Because when you do a 1031 exchange, your basis doesn't increase, right? So your basis that when you purchase the property, that becomes your basis. And when you sell that property, you take those gains and roll into a new property. I guess your basis in that new property is established, but you still carry forward the difference that is your taxable deferred balance over time, right?
Correct. Yeah. So 1031, I always look at it like you already took some depreciation on that first property. And so when you defer it into the second property, that depreciation you already took, you can't take that depreciation again on the second property. But a lot of people will exchange into a larger property. So let's say you bought the first property for 500 and you bought the second property for $1 million. You now essentially have an additional 500,000 of new basis that you can cost seg that has no depreciation taken out. And so as long as you're deferring into larger properties, it definitely is a good strategy to defer your taxes and never pay tax.
Well, one of the things I wanted to talk to you about, and I've heard this being done. I've not personally done it, so I'm curious. It sounds too good to be true, but it seems like it might be possible. Basically, it's called like the lazy man's 1031. Right. So you take a property. So in your example, you buy a property for 500,000, you sell it for $1 million, and just for some simple math, you have a $500,000 capital gain. Well, then you go and invest that capital gain into another property that you also do cost segregation on, and the accelerated depreciation plus bonus depreciation in that year one that you take covers the full taxable income from your last property sale. And now your basis is at that new level and you don't have any kind of tax liability that you're carrying forward. Is that possible? And hopefully my example makes sense.
Yeah, I'll kind of walk through that example. That is a great example, and it absolutely is possible. So I think one thing we need to touch on before we go there is just bonus depreciation.
Yeah,
you mentioned bonus depreciation. So let me just kind of touch on what that is. So back in 2017, when Donald Trump was president, there was a tax overhaul. It's called the Tax Cuts and Jobs Act. And with Donald Trump being a real estate investor, the tax changes were very favorable to real estate investors. And something came out of that. There's something called bonus depreciation that the government's had. It's been around for long before Trump was president. It's been around for a number of years. Bonus depreciation is always used as a kind of a lever to stimulate the economy when it needs to be stimulated. And so they say, okay, the economy's not doing great. So we're going to say, hey guys, if you go out and buy stuff, we're going to allow you to take those depreciation amounts much sooner. And so they give you a percentage. They might say it's, for 2016, it was 50% bonus, meaning you go out and buy $1 million bulldozer, you get to write off 500,000 of that or 50% of that in the first year. The other 50% gets played out over the useful life of that bulldozer. And so two things happened with the Tax Cuts and Jobs Act. One is it went from 50% at the time up to 100% bonus depreciation, which was huge. The second thing is that back prior to that tax law, it had to be brand new equipment. You couldn't go buy a used bulldozer. You had to go buy a brand new bulldozer. And so they changed that and said it just has to be new to you, the taxpayer. So let me kind of put bonus depreciation into context on how it works with real estate. Bonus depreciation only applies on assets that have a useful life of 20 years or less. And I think the IRS did that on purpose because they didn't want bonus to apply to real estate. So they said, well, real estate gets depreciated over 27 and a half and 39. So if we put this at 20 years, it won't apply to real estate. But what if you have a cost seg study done? Now, all of a sudden, we've got 5, 7, and 15-year assets where bonus does apply. And so under the current tax law, any properties placed into service between 9/27 of 17 and the end of this year, 2022, are eligible for 100% bonus. So remember, Ben, I talked about how we segregate those different items into the 5, 7, and 15-year buckets. So if you buy a $500,000 property, we typically segregate around 30% as kind of an industry average. And so 500,000, 30% of that is 150,000 that goes into those 5, 7, and 15-year buckets. Because those buckets are less than 20 years, they're eligible for that bonus depreciation, which means you get to take 100% of those deductions in the first year versus taking them over 5 years, 7 years, or 15 years, right? Instead of having to take 1/5, 1/7, or 1/15, you get to take all of it in the first year. And so that's been a huge advantage for real estate investors to be able to really maximize it. It's basically taking cost segregation and put it on steroids, right? Because instead of accelerating stuff to 5, 7, and 15, we're now basically accelerating it to 1 year because it's 100% or all of it in the first year. So I just wanted to touch on that because I think that's important to your example.
No, that's very helpful. And just to create further context, so without bonus depreciation, what percent of your capital invested in a given property could you expect to have a year one deduction on, just percentage wise, rough estimate?
Yeah, that's a good question. It's hard to answer that just because I do want, and I've kind of oversimplified things. Let me just make it clear that land is not depreciable.
Right.
So if you buy $1 million property in Oklahoma and the land is worth 100,000, that means you have 900,000 of depreciable basis that gets spread out over 27 and a half or 39 years. That same $1 million, if you go buy $1 million property in LA loves their land. California in general loves their land. So their land value might be 800,000, which means you only have 200,000 of depreciable basis. But once you've established that depreciable basis and you've subtracted out the land, you can anticipate about a 30% segregation on that depreciable basis. So again, if you buy a property for $1.2 million, you determine the land is worth 200,000. That gives you $1 million of depreciable basis. You should get about $300,000 of deduction in that first year if you apply the 100% bonus depreciation.
Okay, so let me ask a two-part question then.
Yeah.
So there's the bonus depreciation, which was kind of taking something that's already good, the cost segregation, different shorter lifespans, and just turbocharging that.
Exactly.
Are either or both of those restricted to certain kinds of taxpayers, or are these available to the person on this podcast that's just thinking about buying their first property, say they're a medical doctor? Is this for everybody?
That's a great question. So cost segregation is not necessarily for anybody and everybody. One thing you have to remember is typically real estate deductions are considered passive. So in that example you gave where, let's say I'm a doctor and I full-time anesthesiologist, that's what I do full-time. I've got a few rental properties on the side. If I do cost segregation on those rental properties, the deductions that I create through bonus depreciation and cost segregation, those deductions can only be used to offset income that's considered passive, or my real estate income in that example. So I might make $500,000 a year as a doctor, but those deductions that are created, even though they're large, they're supercharged with all this bonus, I might create a $300,000 deduction. I can't use that $300,000 to offset my tax liability from my $500,000 of W-2 active income. So you've got.
So even if you're an anesthesiologist and your very job is putting people to sleep, that's not considered passive.
No, that is not.
Okay. All right. So I just want to make sure that's clear to our folks watching that.
Yeah, absolutely. There's two types of income. You have your active income, and that's what you do every day for a living. Now, some people are real estate investors for a living, right? So one thing that we see quite often, I'll just go back to that doctor example, is if I'm making $500,000 a year, my wife probably gets to stay home because I make good money as a doctor. Well, she stays home and she manages my real estate. We say that she's the real estate professional because she is, as put out by the definition of the IRS. She spends 750 hours a year doing real estate. She does it more than 50% of anything else she does. If she meets those qualifications, she's our real estate professional. And now those deductions can be used to offset my W-2 income because we file a joint tax return and those deductions become active. They can hit my active income. And so a lot of high W-2 earners who have stay-at-home spouses will try and qualify their spouse as a real estate professional so that they can take advantage of that and offset that high W-2 income. But that's a great question. It's not for everybody.
Gotcha.
But let's go back to the passive, because that's kind of more the focus of our investor base and the listener base. And, so even though it does only give you deductions against your passive income, it does kind of go to the point I raised earlier of if you have capital gains from investments, that is, passive income, and that can be used. And these losses, if you can't use them, do carry over, right? So you can be storing up these losses, even if you can't use them in a given year, they're generated for future passive income. So talk a little bit about that.
Yeah, no, I'll tie that back to your first example, kind of the poor man's 1031 exchange, because there are limitations if you have, there are limitations if you're a passive investor. Again, you can only use these deductions to offset your passive income. But if and when you sell a property and have a large capital gain, that capital gain gets treated as passive income. And so those deductions now become activated. I don't know if that's the right technical term.
I like
activate those that don't look that up on the IRS website, but those become active. And now you can use those deductions to offset that gain, which means you're not paying any capital gains tax.
Is that capital gains outside of the real estate investment thing too? Like what about the sale of a stock portfolio? Would that the capital gains generate from that?
Typically not. Typically only from the real estate. So there are different types of capital gains, but typically only from real estate. If you sell real estate and you've got this passive loss sitting on your books that can't be used, once you sell that asset, creates a capital gain, activates the losses up to the amount of the gain. And here's something that's really cool. Let's say I have a $200,000 capital gain, and let's say I have $300,000 of passive losses kind of sitting on my books, right? They're carrying forward.
Right.
Sell a property, have a $200,000 capital gain. That activates 200,000 of this loss. I have 300,000, but I don't get to use all of them. I only get to use 200,000. But when I use that 200,000, it actually is going to hit on my tax return against my W-2 income, which is great because my W-2 income gets taxed at 35%. So that loss hits my W-2 income before it hits the capital gain, which means I pay tax on the capital gain, but I just offset my 35% bracket by 200,000.
So it's the capital gain that triggered your ability to use it, but you don't have to use it against your capital gain?
Yep, exactly. The capital gain unlocks it, but then the way that it hits the tax return, it actually hits against my higher tax bracket W-2.
Did you know that, Ben?
I did not know that. And
that's
I'm
pretty
thinking
incredible.
you need to create a product that's a button that says activate, and you just hit that button once you're ready to let those losses go.
No, you just go tell people, hey, sell me your property. It's a good acquisition strategy.
Yeah, no, it works very well. We've, the owner of our company here, we actually own this building here. And that's exactly what happened. We did a cost seg study. It activated those passive losses and it actually hit against his W-2 income before. And it's just the way the tax return, it's just the way those numbers flow through the tax return.
Wow.
Which
That's
is
amazing.
fine. I'd rather pay my tax on my 20% tax bracket, my capital gains bracket versus my higher 37% ordinary income bracket. So
What's the carry forward period on these accumulating passive losses that can be generated?
that's a great question. So with the Tax Cuts and Jobs Act, they actually extended it from 20 years to indefinite.
Oh,
So I'll use an example here. Let's say I'm a passive investor. So I'm a doctor again. I've got a couple rental properties. They generate 20,000 of income every year. I do a cost seg study on one of those properties. I create a $100,000 deduction. I'm going to now pay taxes on my passive income for the next 5 years because you remember I'd make 20,000. So I'm going to wipe out 20,000 this year. That leaves 80,000 on the books for next year. Wipe out another 20,000. I'm down to 60. I do that for 5 years. I pay no tax on my rental income for 5 years. Those deductions never expire. They just sit on the accounts. I eventually use them, or as you mentioned, Ben, I sell a property and that gobbles them all up, at once. But lots of ways to apply those deductions.
Great.
Yeah. And I think one of the challenges, as passive investors is it can be very difficult to do a 1031 exchange when you're in a syndication. In fact, it's very difficult to do because you won't get into all that, but so this kind of, lazy man's approach is very attractive because it allows you, because the 1031 in all of its, how impactful it can be, it is very difficult to do, and it creates certain constraints and challenges, especially if you're in a syndication. So as a passive investor, if you can build up these, passive losses and use it against your future passive capital gains, you can effectively, remove not even a tax deferral, but actually, to your point, pay those taxes against the higher bracket income, which is pretty cool.
That's big.
Absolutely. Yeah. No, and I should say cost segregation is one of the few tax tools that I'm aware of that's so flexible. So a lot of expenses, like if I were to go put a deck on my rental property, I have to take that expense in the current year. I don't get to hold on to it, decide when and if I get to use it. Cost segregation, you don't have to do it in the year you buy a property. So let's say you bought a property in 2014, never did cost segregation, and now all of a sudden you've sold the property, you have a capital gain event, and now you're in a tax situation. I can go back and do cost segregation on that property I bought in 2014, pull those deductions forward, offset my current capital gain, and pay no taxes. And so cost segregation, you may not need it this year. You just keep it in your pocket until you do need it. And then you play that card and say, okay, I'm going to do cost segregation this year on this building because I need this amount of deduction. So you can really, if you've got a good CPA who focuses in real estate, you can really do a lot of great tax planning with cost segregation and, apply it to different exit strategies, or there's a lot of useful ways to take advantage of it.
So why would you wait to do it if you can carry those deductions forward anyway?
Yeah, if you can carry them anyway.
So you would wait. The only reason you would wait is two reasons. One is you have to pay for a study. So you don't want to pay me $3,000, $4,000 for a study if you can't use those deductions for 2 or 3 years. Just wait 2 or 3 years, do the study when you need them, and take advantage of them. That's the first reason. The second reason would be it doesn't always make it's not always the best strategy to wipe out your income to zero. So let me back that up. So if I make $20,000 this year through let's say I don't work, I have a couple of rental properties, I make $20,000, that's going to put me in a real low tax bracket. So I might be okay paying 10%, 5%. I don't have my tax bracket sheet here in front of me. I don't know what the tax bracket is on 20,000, but it's not a lot, right? It's a very low tax bracket. So I'm okay paying 10% this year at 20,000. Now, next year, when I sell my property, I have another property that I sell, and all of a sudden I have a $500,000 gain. That's going to put me in a much higher tax bracket. And that's when I want to use my cost seg study.
Makes sense.
It doesn't always make sense just to wipe it out to zero. Even, one of the nice things with bonus that we'll strategize with CPAs all the time is when you do bonus depreciation, it might create a $500,000 deduction, but if you only have $100,000 of income, maybe it doesn't make sense to wipe that $100,000 down to zero. Maybe you only want to wipe it down to $40,000, put you in that lower tax bracket, and then you save the rest of those deductions for next year when you've got money in those higher tax brackets. So you want to use it to manage your tax brackets.
So you can specify that I don't want to use everything I've got in the bucket, right? Or that I'm allowed to use this year. I only want to use the amount that brings me down past that threshold. Or?
There are tools to do that. You can't specify and say, I need exactly $36,000 of depreciation. But in that example where we use bonus, the IRS allows you to opt out of bonus depreciation by class level. Okay. So what a lot of investors will do is they'll say, give me my bonus depreciation on my 15-year bucket, because I'm not going to own it for 15 years. My plan is to own it for 7 years and get out. So give me my bonus up my 15-year bucket. My 5 and 7, I'm going to let them spread out over 5 and 7, which means I'm not getting such a huge deduction in the first year. I'm getting it over 5, 7, and I'm getting, a big bump in the first year because I took bonus at my 15, my 5 and 7 play out. So there are ways to strategize or manage those deductions to kind of hit whatever target you're trying to hit in terms of deductions.
So it can be a real planning tool.
Absolutely. Yeah,
Awesome.
absolutely.
So Erik, talk a little bit about the changes in this year, 2023, as it relates to the bonus depreciation.
Yeah, that's a good question. So when the Tax Cuts and Jobs Act came out, bonus depreciation had a sunset date of December 31st, 2022. So right now, any properties, again, from September 27th of 17 through December 31st of 2022 that go into service in that time frame, you'll get 100% bonus. Anything that goes into service starting next year is eligible for 80% bonus. So instead of getting 100% of your deductions in the first year, let's look at your 5-year category. Instead of getting 100% of your 5-year assets in the first year, you're going to get 80% of that. The other 20% gets spread out over the next 4 years. So still putting cost segregation on steroids, because remember, we used to do cost seg studies before bonus was even around. Taking a 27.5-year asset, moving it to 5 years is way better. But now we're moving it to 5 years and then taking 80% of that and moving it to a year. And so the way the tax law reads right now, every year starting in 2023, it lowers by 20%. So 2023, it's 80%. 2024, it's 60%.
Oh, wow.
All the way until 2027 when it's down to zero. Now, I will state that there was serious talks in this last round of Congress with this lame duck session. With the economy kind of shaping up the way it was, there was some serious talks about extending bonus, 100% bonus into next year. It didn't get through on the final bill, but just because that's the current schedule doesn't mean they can't get together at any point. Hey, the economy is really struggling. Let's just reinstate 100% bonus and try and get people to go out and spend money. So that could happen next year, depending on kind of how things shape up. But currently, 80% starting in 2023, then 60% until 2027 when it's down to zero.
Yeah. And so your expectation, you were saying earlier in your example of the $1.2 million building where 200,000 of it is land, you got a 1 million depreciable part of the property. You can get roughly 30% in a year one tax deduction. What would you expect that to go to now that bonus is going to 80% versus 100%?
Yeah, so you're going to get, let's say, let me do the math here in my head. So on $1 million property, we're going to segregate about 300,000 of it into those short asset lives. You're going to get 80% of that. So you're going to get 240. Plus you're going to get some straight line depreciation on your 27. So you're probably around 250, 260 versus getting 300.
300.
Yeah.
So still very, very, very impactful and, not as good as it was, but still way better than it has been. And, and I would make the point too, that's if you're purchasing this property, if you're purchasing with debt, the percentage to your equity in the property is much higher than just those numbers. They're going to be high. I mean, I've seen deals where it's 75% of your, capital contribution has a tax write-off in year one.
Yeah, no, that's a great point. So remember, our depreciation, what we're calculating it on is purchase price. So I may take only $200,000 and go put it down on $1 million asset as a 20% down payment. When I do the cost seg study, I'm doing it on the $1 million. So I get 30% of that. All of a sudden, I got a $300,000 deduction on a $200,000 investment. And so you're absolutely right. The more you can leverage, the more impactful this could be in terms of getting a deduction on your contribution.
Got it. Very cool. That last question I have, I've always kind of wondered this, but how would you kind of rank asset types from what's the best asset to get the most cost segregation, in year one versus the kind of the worst?
Yeah, that's a great question. So there's kind of 3 unique outliers. So typically I mentioned a couple of times, it's around 30% segregation. So your multifamily, your office building, your retail, those all kind of fall within 27 to 35%. Warehouse industrial is a little bit lower because there's less personal property. But there are a lot of land improvements. You think about a big warehouse usually has big, lots of concrete, lots of curbs, gutters, asphalt, drainage. So, but I would say your industrial is a little bit lower. Your warehouse is a little bit lower. And then as you work your way up, you've got office, multifamily, retail. Medical seems to be a little bit on the higher end because you got a lot of specialty plumbing, specialty electrical. And then there's those three outliers. There are car washes, which are amazing. So you can buy $1 million car wash and you may get $1 million write-off in the first year. And the reason for that is, well, I'm oversimplifying again. Let me back out land. You buy $1 million car wash, you back out 200,000 for land. That gives you 800,000 of depreciable basis. You very well could get an $800,000 write-off. Because if you think about it, when you buy a car wash, what do you buy? You're not buying a building,
Right.
You're buying land improvements, which are a 15-year asset eligible for bonus, and you're buying equipment, which is also a short-term asset eligible for bonus. So those self-serve bays where there's no sitting area, there's no building. Again, you buy $1 million car wash, you could get an $800,000 write-off in the first year. So car washes, gas stations are unique because gas stations, if you sell more gas, which you typically do than convenience, like than snacks and stuff, then gas stations you can classify the whole gas station as a 15-year asset. And again, because 15 gets bonus, you just took bonus on your whole purchase.
Wow.
Gas stations. And then the third one is trailer parks, mobile home parks. Again, when you buy a mobile home park, if there's no clubhouse or laundry facilities, you're just buying land improvements and trailer services, cement pads, electrical, sewer systems. All those are 15-year assets, which means you get a 100% bonus under the current law on those three. So those are kind of the three outliers that are just way out there. Most stuff's going to fall between 25 and 40%. Multifamily is a great asset class because there's a lot of, if you buy a 100-unit apartment building, you got 100 washers and dryers, you got 100 garbage disposals, a couple hundred ceiling fans, and so they're great asset classes as well.
Man, well, Erik, I've never had so much fun talking about taxes.
I know. I know.
That's impressive.
Or the lack thereof, I think is what's the most exciting.
That is the exciting part. I love talking to, you're right. I love what I do just because it's kind of the good side of taxes. I've sat in a lot of tax seminars where it's, no one likes to talk taxes, but if you can talk to me about how not to pay taxes, I'll listen all day long. So I appreciate it.
Awesome. Well, Erik, if folks do have active investments or even if they're in some passive deals and, want to encourage sponsors to get cost segregation, if they're not, what's the best way to reach out to you?
Yeah. So you can reach us on our website. Our website's just www.costsegauthority. That's segauthority.com. My contact information's on there. Please use us as a resource. We don't bill by the hour. We're kind of a unique accounting firm where we just do these cost segregation studies. And so we partner with your CPA. CPAs are kind of like your general practitioners. They know a little bit about thousands and thousands of pages of code. We dive deep just into one section of the tax code. So we're kind of like the brain surgeons. And so they'll usually partner with us when they have a client that owns real estate and say, hey, can you run some numbers? We always do a free analysis. We never want to engage with somebody if they're not going to save significant tax dollars. So if you buy a property, you can give us the closing statement and we can come back and say, hey, based on the information here, we anticipate increasing your depreciation by X amount. The study's going to cost you X amount, and then you can decide if it makes sense from there. So always get a free analysis done on any revenue generating property. I would always suggest you get an analysis done just so you can use it for tax planning and kind of going forward. But yeah, please use this as a resource. I always joke, I think the weirdest question we've ever been asked is how to depreciate deer at a breeding facility in Wisconsin. I didn't know the answer, but I was able to talk to one of the guys upstairs and get the answer for him. And so,
what was the answer?
I don't remember. It's similar to livestock, but it was one of these breeding facilities where they had all this land and they take these bucks and they breed them to have these huge antlers. And people pay ridiculous amounts of money to sit on the porch and kill these things. There was a specific way to depreciate those, like I said, it was kind of treated similar to livestock, but again, we can find the answers. If it's anything to do with depreciation, we'll get you the answer. So please use this. Yeah.
That's awesome. Thanks so much for coming on. I definitely learned a lot and hopefully our listeners gleaned a lot of information as well. And appreciate you sharing your wisdom.
Thanks, Ben. Thanks, Jim. It's been great. Thanks for having me.
All right. Thanks so much.
Take care.